Hello and welcome to the World Built Environment Forum webinar series. My name is Simon Rubinsohn and I head up the Economics and Market Surveys team at RICS. And today we're going to be discussing the outlook for the commercial real estate market, particularly in the light of the release this morning of the Q1 RICS commercial property monitors. And to help understand what's going on in the real estate world at the moment and how things are likely to evolve, I have got a very top-notch panel with me today. So I'm going to first of all introduce them, and then we will move on to look at some of the issues, starting off with a short presentation by one of my team. So first of all, Greg Hyland, who is Head of Capital Markets in Asia Pacific. Welcome, Greg.
Thanks, Simon. Pleasure to be here. As Simon mentioned, I lead CBRE's capital markets business across Asia Pacific, which at the moment we've got around 600 professionals. Geographically for us, that's Australia, New Zealand in the south, Japan, China in the north, and India in the west. But I'm looking forward to this afternoon's discussion.
Thank you, Greg. Next up, I have Suvishesh Valsan. He's Director of India Research for Cushman and Wakefield. Welcome.
Yeah. Hello, everyone. My name is Suvishesh Valsan. I currently head the India research practice at Cushman and Wakefield, India. And I've been into the research domain for last 15 years, delving into the India macroeconomic research, a brief period into equity research space, and thereafter in the real estate research for more than a decade now. I will be addressing the audience from an India market point of view to cover perspectives about cities such as Mumbai, Delhi NCR, Bengaluru, Pune, Hyderabad, and the likes. Looking forward to having an insightful conversation with all of you today. Thank you.
Thank you. Yeah, looking forward to hearing your thoughts and all of that. And then we have also Dr. Megan Walters, who is Global Head of Research for PIMCO Prime Real Estate.
Thanks, Welcome. Simon. Thank you. It's great to be here. I'm Megan Walters. I work for PIMCO Prime Real Estate. Previously, we were known as Allianz Real Estate. We invest on behalf of the 37 pools of capital for the Allianz Insurance Group. I'm based in London. But I spent many years in Asia Pacific, both in Singapore and Hong Kong. So it's great to be back with old friends. Thank you.
Thank you very much. Looking forward to hearing your thoughts as well. And the final member of the panel is a member of the economics team, Donglai Law. And good afternoon to you, Donglai. And you're a senior economist in my team. I think you're on mute.
Sorry. Thank you, Simon. I am teaming up with Simon to monitor the APAC market dynamics, and today I will share some of our latest findings from the Global Commercial Property Monitor of RICS, and I look forward to hearing thoughts from you, not only from the panelists, but also from the audience, so that I'm looking forward to the discussion. Thank you.
Thank you, Donglai. So first of all, I just want to remind everyone that this is meant to be an interactive session. So we really do want to get your thoughts, your questions for the panelists as we go through the next sort of hour or so. And I know people are still coming into the webinar, so I will remind you of the ability to use the chat function to put questions to the panelists as we work through the session. Before we actually get to the discussion, I will ask Donglai just to give us a few minutes talking about the key results from the Commercial Property Monitor. I mentioned that we'd released it overnight, and it's now on the website. So hopefully you'll in due course take time to have a look at the full report. It is, remember, a sentiment survey based on responses from RICS members around the globe, typically between 2,000 and 3,000 each quarter. So it's a pretty good high frequency survey. I'm going to turn over to Donglai now, and he will, I think, share the screen to highlight some of the key themes, and then we'll come back and have the discussion. So Donglai, over to you.
Thank you. just as Simon mentioned, we have our quarterly monitor for commercial real estate and also for construction. Today, we're focusing on the commercial property side, and I'm happy to share some of our findings in the latest results. The first point I would like to talk about is that we see a general recovery of the APAC markets, leading mostly by China and Hong Kong, reopening from the zero COVID policies, and we have readings both for occupier sentiment index and also for investment sentiment index highest seen since 2019 Q2. And later we'll see that where is this momentum coming from. And on the country level, it's more like a mixed story. India and Singapore are on the stronger end, while Australia and Japan reflect comparatively weaker sentiment. On the lower end, we could see that China and Hong Kong really recovered a lot from the losses in previous quarters. And and also we can see that Sri Lanka has boosted its sentiment of the local market. And we have also surveyed our respondents on the local credit conditions, and we found that there is a significant difference, or we say divergence, between the developed markets and the developing markets in the region that we see. For China, India, Malaysia, and Sri Lanka, the credit conditions are comparatively better than that seen in Australia, New Zealand, Japan, Singapore. And Hong Kong may be the only exception that just recovering from the COVID restrictions, they have boosted of the investor confidence in the market. So we could see actually some relief of the local credit conditions. And drilling into the credit conditions correlation with the local investment sentiment, we found a more or less linear relation between the two factors. However, there are some outliers that is indicated in this graph. Singapore, despite its deteriorating credit conditions, the investment sentiment remains high. And on the other side, Sri Lanka, although we didn't see more deterioration of the credit conditions, the investment sentiment is not picking up, which is measured by our net balance of the investment inquiries. And as we recover from the COVID crisis, most of the APAC companies are partly applying working from home policies, and some have been applying the returning to office policies. So there are some difference regarding the office availabilities and also the occupier demand. And we could see that only India and Singapore have strong performance of both metrics, and we see that Japan, Sri Lanka, and New Zealand actually showing less intention to return to office, and on the other side, the availability has growth in all of these surveyed markets. Last but not least, since we are talking about the new commercial property cycle, it's good to see that our respondents' perceptions on the local markets. On the stronger side, we see for Singapore and India has more people responding perception of upturn or peak of the local markets, while on the weak end, we have Australia and New Zealand, including Japan, with people who perceive the market more in the downturn or at the bottom. China and Hong Kong obviously benefited from the turnaround of their COVID policies, and remain more or less a reasonable place in the middle. And heading back to you, Simon.
Okay, thank you for that, Donglai. I mean, I think that what seems to come over in terms of the APAC results here is that there's obviously quite a mixed picture between, and that reflects the nature of the markets in the region, and I'm sure we're going to get more of that. And certainly, if we look at the global results, it's also fair to say, just giving you a heads up, that the story is a little bit more of a mixed bunch. But I'm not going to dwell on that really. I'm going to hand over now to Megan Walters to get her thoughts in part on what Donglai said, but also just a broader perspective on what you're seeing in terms of the real estate world at the moment.
Thanks, Simon, and thanks, Donglai, for the presentation. That was really interesting to see. And as you say, a mixed bag in terms of what we're expecting, which I think kind of reflects where we are just in terms of a global picture. There are good bits and bad bits going on at the moment. So look, just to pick up with some numbers, and I've used the IMF numbers here because they're available in the public domain, well worth a read, out in April just recently. So let's just start with kind of global growth. All real estate is demand driven by sort of economic growth. So IMF numbers for this year, 2.8%. So it's going to feel worse than last year at 3.4%. Before settling at kind of about 3% next year. Now, this 2.8% this year, the long-term average for global growth is 3.1. So anything below that kind of 3.1 is going to feel worse. On the plus side, China opening back up. So China expected to be about 5% this year. So that's going to help the region. But places like Singapore and Australia, they did really well last year. So Australia 3.7% last year, Singapore 3.6% last year, but both of them expected to be kind of less this year, 1.7, 1.6% kind of growth range. The big standout is India, and I saw Suvishesh will talk about the standout for India. So last year 6.8%, this year 5.9%. So really continuing its kind of growth story. The big picture though is global inflation. So globally 8.7%, likely to sort of trend to about 7% this year, but really expectations from the IMF are it doesn't go back to anything kind of nearing normal until about 2025. So there's a number of reasons for this. Some of this is supply chain disruption after the pandemic. Some of it is monetary stimulus, particularly in the US, and some of it is energy pricing due to energy shortages from the war in Ukraine. And we don't know how long the war in Ukraine is going to go on. And then obviously we're working on alternative energy supplies for Europe, but we have another winter to go through. So still quite a mixed picture out there. All of this has resulted in the US Fed, one of the most dominant central banks globally, continuing its historic tightening of monetary policy. Another meeting next week, so possibly another quarter basis point rise up to about 5.5 to 5.25 in terms of policy rate. Hopefully that might be the peak of where we get to. Our PIMCO economists are predicting a mild recession for the US coming up. I appreciate this morning, I think the quarterly results are going to be out saying it's, there's been some slight expansion, but generally US possibly heading into a mild recession. Now, that should mean that the Fed doesn't need to raise interest rates anymore if it's done its heavy lifting. That then, a US recession will probably have a similar effect onto Europe. So recession into Europe as well, perhaps a mild one, which means that we might also start to see the peak of interest rate rises in Europe as well, with their terminal rate perhaps 3.5 to 4%. So the bright spot in all of this, though, is for Asia, where we do still have growth. We're a growth region. We have good demographics, rising economic activity, and actually lower inflation. So hopefully that should mean that the central banks around Asia may be able to sort of limit their interest rate rises, or at least reach a peak earlier and perhaps start a rate cutting cycle earlier than you might see. So for real estate markets, this, as I say, this historic rise in monetary tightening has dried up debt markets and has caused a seize up. But I think we'll stop there in terms of moving on to the real estate markets. Thanks, Simon.
Okay, thank you very much for that, Megan. And I'm sure we'll come back to some of the macro issues over the course of the next 45 minutes. But I just wanted to get Greg's take on how this is likely to play out, and in your thoughts about sort of real estate activity?
Yeah, look, if we look at it sort of broadly, and I think Donglai touched on it earlier, the economies in Asia are operating at different speeds at the moment. So if we look broadly across our business, we talked about the recovery in China. It is real, it is happening, but there's still an element of caution, and people are really looking to see how the performance will be through the first half of this year. And if those indicators continue to remain positive, we expect volumes to come back quite strongly in China. Japan's been a standout performer and has continued to be a standout performer over the last 4 or 5 years. Transaction volumes continue to remain really robust. Pricings remain firm, and whilst monetary policy there is accommodative, we don't see that situation changing. I think if you look at some of the developed Asian markets, the ones that have suffered the most dislocation has been South Korea. Interest rates there have moved up quite considerably, so we've seen a material drop-off in transaction volumes. And if we move down into the Pacific region, we touched on Australia, transaction volumes have really dropped off quite materially, and we started to see that in the second half of last year, and that's continued into Q1. Interestingly, we're starting to get price discovery in some of the asset classes, particularly around office, where we've probably had the most dislocation. So we think that volumes, provided the RBA's policy settings remains relatively neutral from this point forward, we'll start to see recovery in volumes in the second half of this year. I might pause there, Simon. Happy to sort of, if you want me to sort of go any other places, but I'll pause there for the moment.
Well, that's great, Greg, and I'll come back to you shortly on that, because I've got some questions to follow up on that. But I thought it'd be useful to get the India perspective as well, because Megan highlighted the economic performance that India has been sort of racking up. So and certainly the results, as Donglai indicated from our monitor from India, have been positive. So we're certainly getting good feedback from our professionals working in the country. So any thoughts, Suvishesh, on what's happening at the moment?
Yeah, so I think from Donglai's presentation, I think he touched upon 3 core aspects. One is the occupier sentiment, one is the investor sentiment, and from an availability point of view, where it all stands. So I think India has just come out of a year which was a record high year, 72 million square feet of gross lease volume, of which net absorption was close to about 37 million square feet. So these were historic high numbers. They beat even the 2019 volumes, which was the pre-pandemic peak, so to say. We do see, in the first quarter, we do see that momentum carrying on a bit. But obviously, given what is happening externally, across the globe, and given that India is, often driven by occupier sentiment, in the West, or investment sentiment in the West, we will be looking at it very closely. At this point in time, we are seeing optimism with a bit of a caution. That's sort of occupier sentiment. But from an investment sentiment point of view, yes, we do see some slack, since last 4 or 5 months, where let's say if a quarterly average, private equity inflows into India was roughly about $1.25 billion, but that has tapered off a little in the last 2 quarters or so. Today we stand at $1.1 billion. So we'll be keeping a close eye on that, and naturally this was anticipated, because given the aggressive monetary policy stance across the globe and even in India, 250 basis points rise in interest rates in last 1 year. This is the most aggressive that we've ever seen in modern history. So this was sort of anticipated to some extent, so to say. But there is another angle to the story, is that while we believe that the investor appetite is looking for some good quality assets, and quite a lot of these prime assets have been already taken, and I think it'll be very important to see what future supply holds in terms of office, warehousing, retail. There are some prime assets, if they are available, how fast they are stabilized and how fast it is attractive for private equity players to, again become active in India. So I think even the asset quality mismatch is also leading to some sort of a limited volume that we saw in the last 4 or 5 months. From a office availability point of view, the good part is that, because of the bullish sentiment that we saw in India, especially in the office sector, there were a lot of developers who poured concrete, and there is a very healthy pipeline in India of projects for 2023 and even the foreseeable years of up to 2025. So I think especially in cities which are driven by tech, like Bengaluru, Hyderabad, and these kind of cities. So I believe this is definitely helping the occupier-friendly market to prevail for some time, because in certain micro markets in India, especially the prime markets, the vacancies are right now too tight, and we were of the opinion that possibly rentals would rise faster than expected. However, given the healthy supply pipeline, we strongly believe that the occupier-friendly environment will prevail for some time.
Okay, thank you. And I will come back to you on some of those issues shortly. Actually, Megan, I just wanted to ask a more general issue. I mean, you're sort of taking the IMF view there, and I mean, there's some people who feel the IMF's perhaps, if anything, a little bit too sanguine on the inflation front. I know you talked about 2025, but some people have suggested that maybe they are. And if we were to see, particularly, and I'm thinking in the more mature markets, a bit of a tangle on inflation, which keeps interest rates higher. I mean, from your perspective, can you see some parts of the world, like the parts of perhaps APAC and parts of, dare I say it, the Middle East, where I mean the investable world universe is a bit smaller perhaps, but nevertheless, can you see some of the funds shifting their focus if this inflation environment in the US and parts of Europe proves to be a bit more of a challenge?
So at the moment, we think there are basically three pools of capital that are looking for a home in real estate. Some pools of capital, so for example, European investors, because the denominator effect may be at their target allocation. So very often investors seek to have somewhere between a 10 to 12% allocation to real estate, because real estate pricing has held up remarkably well in the kind of direct real estate market. Valuations have not come down that much compared to some of the public markets. So we've got a reasonable stability in we have a very large portfolio of directly held real estate. And the values for that have maintained their position. By contrast, generally equity markets and bond markets are down, and so that limits the amount of additional money investors can put towards real estate. So that's the denominator effect. Now there are pools of capital which are not yet at their target allocation. Asia Pacific investors being one. So we tend to use the INREV and REV investor intention survey, which we think is a good metric. Asian investors are at about 8% and still want to be at about a 10% allocation. So we think Asian investors will continue to put money into real estate. And just on price discovery that Greg was mentioning, we've got price discovery in London, partially driven by Asian investors buying in London recently, in the last 2 or 3 months since we've had this big rise in interest rates. So we can come on to that. The other two pools of capital that we see, Middle Eastern money, oil money. We've had a big rise in energy prices. There's money around in the Middle East. And then the third group is always high net worth families. And I actually mean that globally. We've had a high net worth family buying a couple of, big assets in Paris, European high net worth families. And the main reason for that is this desire to hedge against inflation. The other thing to come out of the investor intention survey is, why do you invest? And primarily diversification is the #1 reason, particularly for direct real estate. It reduces the overall risk in your portfolio and enhances your risk-adjusted returns. And some sectors like Japan multifamily do that massively reduces your risk, provides nice steady cash flow. But then the other reason, which has really risen up really quite strongly in the survey, is this desire to have real estate to hedge against inflation. So back to your point, Simon, if we're going to continue to see inflation for quite a long time, we might continue to see continuing allocations to real estate, because there are some all equity deals out there, or some deals where people take debt initially but pay it back down really quite promptly, because they actually want to park the cash as this hedge against inflation, or because debt financing just isn't accretive to the deal anymore.
I mean, it's interesting. I mean, I think this issue about inflation as a hedge, it was certainly about a year ago, I was scanning around to try and find papers to justify. I would just wonder whether in the current, perhaps new world of real estate, where perhaps lease lengths aren't quite what they were, and upward rent reviews aren't what they were, perhaps the inflation hedge may not be quite as supportive. But I don't know. I mean,
no, I'll answer that, and then I'm going to pass it on perhaps down to Greg there. So it depends on the market. So we took 40-year data. There are 5 markets globally, and I'd like to thank Richard Barkham for helping me out with some of this, with some very old data back in the 1970s for London. So we took 40-year data from 1980 through to 2020, 2022 up to modern times. Provided you take a sufficiently long time period, real estate is a hedge against inflation, but it will not hedge you if you buy at the top or the bottom of the cycle. So when you deflate the cycle, you can see really clearly supply and demand cycles within the real estate, but over a sufficiently long time period, it is a hedge against inflation. Now, if you buy at the peak of the market, inflation is not going to save you. If you bought at the peak, you're going to lose money. But over a super long run time period, and that's the longest we can do, it does hedge. Now, within specific markets, Europe being a good example, leases are very often indexed to inflation, and so that process works relatively well. And for the portfolio that we look after, we do have a lot of the assets are in that sense hedged against inflation, because the leases contain indexation to inflation. I'll stop there, and perhaps Greg, do you want to pick up on that elsewhere?
I mean, just a piece on inflation, Megan, but what we're also seeing is on the supply side, the economic rents to build new product now has increased dramatically. The inputs of construction inflation, higher interest rates mean that the bar to get new supply out is just so much higher. So that really puts I suppose a floor in the occupier market in terms of where rents will sit. So yes, we are going through an adjustment period, which Megan sort of touched on now, but we're setting ourselves up for a pretty robust recovery, because you're going to have this period of very little underdevelopment due to the economic rents that are needed to make these projects work. So yes, I agree with Megan. Over time, it is a natural hedge against inflation.
Okay, thank you, Greg. Can I just ask you to continue, just because I always just remind everyone, we really want your questions. We want this to be as interactive as possible, so please use the chat function. But we do have a question there. In fact, it's a multiple question. I don't know whether you want to take it, Greg, which talks about the biggest beneficiary of the exodus in Hong Kong, the cost peaking in Singapore, and also a bit about Philippines and Malaysia. So I just wondered whether you had any thoughts on what is quite a wide-ranging set of questions there.
I'll take the Hong Kong and Singapore, because I'm actually based in Singapore, and I've actually been to Hong Kong twice over the last month and going back again next week. And anecdotally, what I can feel and see on the ground is the place is coming back. There's a lot of buzz and activity, whilst I think it takes time for airlift to return to normalised levels. And if I look at Singapore as an example, it took close to 12 months for air traffic to normalise, if it has actually normalised back to 2019 levels. So, what I've seen and what our teams on the ground are telling us is that Hong Kong is coming back. It does have an issue around interest rates. It follows US dollar monetary policy. So, interest rates there have increased dramatically, and in a market where you've had historically very low cap rates, that's proving challenging from a transactional perspective. But from a business confidence perspective, since the reopening, we can see Hong Kong recovering quite strongly. Singapore has been a beneficiary during this period, and costs have increased quite significantly in this part of the world. I think both Hong Kong and Singapore coexist together. Both offer different geographic coverages, very similar in the way that they operate. So, I don't think there's a winner. Both cities will continue to thrive. I think Singapore has tried to diversify its economic activity more towards tech and biotech and other industries, and sort of become a bit more diverse in the way that they generate growth and the type of growth that they're looking to achieve. But again, my view is both cities are going to continue to be super strong and really important sort of hubs for investment across the region.
Okay, thank you, Greg.
Can I add to that? Because I think the other thing that Singapore's done is build a strong connection over to India. So Hong Kong obviously looks towards China, quite understandably, whereas I think Singapore has a strong sideways looks towards India and down to Australia. So I think Suvishesh could perhaps add a bit there. So it's
right in a way, because out of the the global investors who are active in India, while we have the largest asset owners as Blackstone and Brookfield, who are from US, however, GIC is another very, very strong player in India, and these three are the mightiest. They hold a pretty large grade A assets in India from an office point of view, and they are active in terms of exploring other asset classes as well. So yeah, I mean, there's a strong nexus within these two economies. I think even before REIT got listed in India, the first Indian REITs were actually listed in Singapore, through the Ascendas route. So I think yeah, I agree to what you're saying.
Thank you for that. Can I just bring Donglai in for a second, because I know you were doing a presentation this morning. I know this focus is really commercial rather than residential, but you were doing a presentation this morning. You're involved in a panel around Singapore residential. And what was the feedback, just in the context of this conversation? What was the feedback at that event?
Yeah, thanks, Simon. And I think I totally agree with Greg on that. Hong Kong is at the first phase of reopening, and obviously Singapore has reopened quite a while ago. So they are at different stages of reopening, and that might give Hong Kong more time. Let's give Hong Kong more time to recover. And from the talk you mentioned, Simon, that I did confirm there are like alternatives to Hong Kong that those companies are considering about relocating, not only in Singapore, but also like, as mentioned, Malaysia or India or even Taipei, Japan. So there are many options for them, not only for Singapore to absorb all the business coming from Hong Kong. And in fact, I did notice from our commercial survey that in Malaysia, there is a higher demand of industrial occupiers demand that would somehow maybe related to this question. And yeah, thanks.
Okay, thank you. And look, Suvishesh, I mean, I know that, I think Greg was talking about the pipeline of new supply generally, and in a way, a relatively sluggish pipeline of new stock coming on. You were talking about asset quality mismatch. I mean, what is the pipeline in India? Are we going to see more good quality stock coming through? And is it going to become, therefore, perhaps a more sought after investable sort of opportunity?
Yes, so we are talking about close to about 180 million square feet of new supply coming in over the next 3 to 4 years, and these are I think India is a story where a lot of transformation is happening from the unorganized space to the organized space. So pretty a good chunk of assets are being cornered, or now the ownership lies with listed developers or with developers who have financial institutions. So in that sense, the relevance of these stocks, the relevant stocks, so to say, they sit a lot with these sort of developers or financial institutions. And going forward, these are the institutions which will have the muscle power to sort of deliver, on time. And even occupiers are, leading forward towards, booking space or pre-leasing space in assets which they consider as more stable or can be delivered with better quality. That's one. Another thing that we are observing in India is about the increasing share of buildings which are having green certifications. Either it is through LEED certified buildings, or it is through the IGBC certified buildings. So in leading cities such as Mumbai, Bangalore, Delhi NCR, you have quite a few buildings now, who have applied and secured these certifications. So I think, we going forward, we are looking at, more relevant supply coming in. That's the outlook from a, future supply point of view.
And can I just follow up then, because you're talking about, okay, perhaps it's an early stage, but some buildings applying for these certifications. I mean, is that reflected in the level of, a demand? Is it demand driven? And are we seeing pricing, sort of reflect that appetite? Is there a premium for these buildings?
That's $1 million question, Simon, because I think the transformation is very recent. And honestly, we would expect a premium to come for such sort of buildings, but at this point in time, as I said, there is quite a few. The supply pipeline is healthy, and to attract a premium for something which is a marginal product differentiation at this point in time may be difficult. However, the outlook is very, very bright, because most of the occupiers, they have their net zero targets coming in pretty early, sometime towards the end of this decade, and we would believe that the built environment will have to suit these needs very soon. So I am of the belief that very soon we will start to see limited vacancy and higher premium in rentals for buildings which have such green certifications.
Okay, interesting. And I was actually talking to someone from CBRE yesterday in London, who was, when we were sort of just discussing the polarization of assets in the London market between the good and the rest, I suppose, and the better quality and the rest. And I suppose environmental standards perhaps are an important part of what makes something prime these days. But I don't know. I mean, Megan, what are your thoughts on this? First of all, the environmental issue, and then that broader polarized. Are we seeing this polarization more generally, or is it in certain specific markets?
So let's start with the investors. So many investors, as Suvishesh was talking about, are and occupiers are part of a net zero carbon movement. For the investors, it's a formalized group called the Net Zero Asset Owners Alliance. It's got about, I think the total AUM of the sort of people in this alliance is about 10.7 trillion of AUM. So, this is a pretty sizable thing that's going on here. So people are committed to this net zero. Now, it varies, less so in the US, far more so in Europe, and I think it's probably about 50-50 in Asia. In terms of, do you get a premium? Obviously, that's quite hard to determine, because most new buildings are always built to a higher standard. So how do you separate the fact it's just new from other formats? But our other colleagues at JLL did a nice test run on London. So London is a great market. It's good for price discovery. It has foreign buyers. You've got a nice pool of assets. You've got the West End, you've got City, you've got Canary Wharf, all with 3 different vacancy rates, all with different sort of, characteristics. So it's a great kind of pool to test. So I think they did a survey of about 500 to 600 buildings, and then controlling for age and controlling for location, all sorts of things. They found that if you have green certification, good quality green certification, you get 11% on the rent, and you get about 20% on the capital value, because you get a yield movement as well downward. And I know that Cushman, CBRE have done similar exercises. That's the one I happen to be looking at most recently, and it's London. And I think that helps drive this globally, because the thing about London is it really is an international location. If you are a Singapore buyer, developer, your choice is you can buy in Singapore, Sydney, or London. If you're from China, you can buy in Shanghai or London. Wherever you're from, London keeps coming back as being the key main alternative to what's going on. And so then that helps set investors thinking around ESG in terms of yields. So, there have been 3 big recent deals in London that have set price discovery. One New Street, 4.7, that was China Chem buying from Landsec. So, Hong Kong owner buying from Landsec at 4.7%. One Fencourt actually was Munich Re buying from Generali, and Winchester House was a CIC Investco selling, and that was at 5.3%. So those numbers sort of set out that a basis point move in terms of cap values, probably 50 to 75 basis points. So when Greg was talking about price discovery earlier, that really starts to set what you can see in London, and therefore will help sort of set what you can see elsewhere. So that was kind of 2 answers for one. So definitely ESG, but it's the fact that it does help sort of spread what's going on. And perhaps we'll come on to the polarization of, does anybody want secondary office later?
Yeah, no, I do want to get there. But Greg, I mean, given what Megan said, how are you seeing this in, and obviously I'm sure the story is very different in different parts of the sort of the landscape that you're looking at most closely, but do you have any thoughts as to how it's playing out?
Look, I think as Megan said, it's probably a mixed bag in Asia in terms of adoption, but the way that we look at it is you primarily have three major stakeholders. One is the investor or the owner, and as Megan sort of indicated, a lot of the larger global groups and increasingly, Asian investors as well are adopting a zero carbon stance. So that's driving where they're going to allocate incremental investment dollars. If you look at the occupier side as the second stakeholder, a lot of corporates, have come out with statements that they want to move towards carbon zero. So they're looking at occupying buildings that meet or have a pathway to meeting those goals. And then the third one is really the framework that government set up around, in individual countries around adoption of sort of carbon zero policy. So it's from our perspective, it's really being driven by those three stakeholders. It's happening in Asia at different speeds, but I think the general direction is that everyone will end up heading in that direction. It's fair to say probably the Europeans, where Megan's sitting, is probably the most advanced at this stage.
Okay, and then thinking about that sort of polarization in markets, I assume, and we can let's work backwards. So I'll start in India, but I assume that the polarization is less of a factor in the Indian market than perhaps in some of the others, just because there probably is, as you say, partly there isn't perhaps that much stock to start with.
I would suggest that it's
Sorry, Greg, go ahead.
Yeah, no, I just suggest, and this is a broad comment, and Megan sort of touched on it earlier, in a lot of the Asian markets, a lot of the stock is brand new. So by definition, it's adopting, it's already sort of at the sort of latest credentials and is already, has already sort of got the certification. So it's not like we're going cities in London where you've got buildings that are very old and in need of capital to get to these standards, whereas a lot of the Asian markets, they're developing new buildings.
Interesting point. And Suvishesh, I mean, what are your thoughts then on the back of that?
Yeah, from an asset polarization, I think what is important to discuss here is the relevance of the existing stock going forward. I think that's an exercise which probably across the globe people have been talking about in the real estate field. And even in India, we have seen some sort of a polarization where what constitutes relevant stock, that's given the evolving occupier preferences, for a better well-being, better amenity building, work-life balance, buildings that provide flexibility, either in terms of having, let's say, a flex seat organizer, organizing the flexibility aspect, or in terms of adding mixed use integrated developments into the office buildings. I think all of this will determine what sort of projects will stand out the test of time in coming years. And I believe that the occupier preferences are evolving very, very fast. Talent attraction, we all know the Great Resignation era, which we just lived 1 year back. And talent attraction was a very, very important aspect. That is going to become all the more important going forward. And I think the built environment will play a very, very important role. So I've often heard, assessment being done, across the globe on what's the level of obsolescence that sits across various micro markets, and which are the buildings that would possibly be relevant going forward from here. I think that's where your discussion on polarization sits at this point in time. So if you were to focus at the traditional CBD markets, even in India, like Mumbai CBD market or the Delhi CBD market, the average age of buildings there is upwards of 40 years, whereas the newer SBD markets, they would have an average age of about 11 to 12 years. And naturally, with this sort of an age difference, you have a lot of obsolescence sitting in the CBD markets. Now, how whether these assets are being refurbished If they are refurbished, there is a requirement of massive capital, in which case are institutions, funding these developments? Is it an asset which is owned by a listed developer for whom access to capital is cheaper, as against some other developer for whom refurbishment will be a lot of cost and maybe the project is not viable? So all of these things are, under discussion at various stages, and that's where I think the polarization argument sits.
Yeah, that's really interesting. Can I just remind everyone again, listening in, we really do want your questions, so there's still time to ping one in the chat function, so please do. Thinking about obsolescence more generally then, and just the changes in work preferences, Megan, you sort of referred to it, and we actually we've been talking to an occupier group again, and I don't want to get fixated by London, but I was talking to an occupier group yesterday. We ran a very small survey amongst that group, and we were just trying to understand what the difference is between what employees want in terms of coming into an office and what employers want. And there is a bit of a disconnect from what we could see in the UK still. But from your perspective, how is this playing out more globally? Obviously with a focus on APAC if we can. And what does that mean in terms of that office sort of estate?
So at the start of the pandemic, I'd left Jones Lang LaSalle and moved to Allianz Real Estate, and within 3 months we were into the pandemic. Allianz Real Estate has one of the world's largest office portfolios, and so one of my very first jobs was to assess this global office portfolio of 225 assets spread across 47 cities globally and come up with some kind of plan as to which cities or which assets would be most resilient to the working from home trend. So we spent quite a lot of time thinking about this. And actually, some of the results have been borne out in how many people have gone back to the office. In general, high density cities tend to have people go to the office because in a higher density city, you've already got well utilized office space. So there wasn't much space give back there. In high density cities, apartment sizes tend to be smaller. In high density cities, public transport systems tend to be economically efficient. So if you look at high density cities of Shanghai, Singapore, Hong Kong, Tokyo, they all have a population density of about 10 to 12,000 people per square kilometre in the hearts of the cities. And those are some of the highest densities. Once you get, and they're all back to the office, 80–90% plus. Once you get away from those numbers, and people are nodding, which I'm very happy about, so people tend to be back in the office. They are absolutely back in the office for Asia Pacific, and that will help drive demand for office in Asia Pacific. When you come outside Asia Pacific, Europe is about 70% back to the office. The most dense cities in Europe are London and Paris at about 6,700 people. Office utilization Tuesday, Wednesday, Thursday is pretty high. It's the Monday and Friday, which might be less. The other point though about Europe is if people are going to the office slightly less, their utilization rate is about 70%. It actually makes the footprint of big cities get bigger. So the draw, so for example, London and Paris, the draw for London and Paris can be even bigger. The residential area that they can pull from can be even bigger if you're only going to the office 2 or 3 days a week. So that's kind of counter side. It might change, sort of maybe it pulls from a bigger area. So actually suburban office in some of these European cities will do badly because what you might have gone to your local suburban office, now you'll take a job in the heart of the center of the city and travel in. The most interesting one is the US, where the US cities have surprisingly low density rates. Apart from Manhattan Island, which has about 9,000 people per square kilometre, so it puts it up there with places like Singapore. Apart from Manhattan, everywhere else is surprisingly low density. So LA runs for miles and miles, has about a 30 million population, about the same size as the sort of greater Tokyo area, but its density is only about 3,000 or 4,000 people per square kilometre. So people have to drive for miles. The commute time in LA is hideous. And so you've got cities like that where, yeah, office utilization rates are 40 or 50%. So in that sense, to draw it back to Asia Pacific, if you want to be an investor in office markets, Asia Pacific is definitely the place to be.
Thank you. And yeah, I think that probably comports with some of the data that we're getting out of our survey. But Greg, I mean, what are you seeing?
I would 100% concur with what Megan's just said. Yeah, where I think, and the way we look at it is everything sort of Singapore North, so a lot of the Asian markets, we're pretty much back to pre-COVID levels of utilization. There are some industries
pretty full,
yeah. So there are some industries which are laggards, which have policies that are, I suppose, more global in nature than Asian, and they're sort of lagging. But on whole, the Asian markets are very much sort of back to normal. I think Australia is probably somewhere in a slight halfway house between probably Europe and Asia. So it's not quite back to utilization. And it was interesting, Megan's comment around the Monday and Friday. I have, and I won't name sort of companies, but I have heard differing reports from people that they do track people's activity on their laptops and phones on the Monday and Friday, and productivity is materially down from when they're actually in the office. So whether that over time forces companies to make a full work week again, I don't know the answer, but the companies are monitoring the activity and productivity of staff, and they have seen that it is materially down on a Monday and a Friday.
Interesting. Perhaps we won't make any more comments about that.
And I'm sitting in the office at the moment.
I assume in India, though, Suvishesh, that the utilization rate is pretty much back.
Yes, I mean, I think I agree with both what Megan said as well as Greg said. I think it's a mixture of both. So yes, the high density cities, the densest in India is Mumbai, and you will see that the return to office percentage is very, very high, upwards of 80%. Similarly, in the megapolis cities of Bengaluru and Delhi NCR, we've seen the return to office pretty high. But another aspect which we have noted here, and that's where Greg's point come in, is about which sector are we talking about. Now, Mumbai being the financial capital, there's presence of large multinational banks. They have the headquarters in Mumbai. Similarly, there will be professional services companies here, and most of them will be headquartered here in Mumbai. That's what is also driving the return to office higher in Mumbai, whereas most of the large multinational IT companies, which are there in India, and we all know that Bengaluru is touted to be the Silicon Valley of India, and there we've seen the return to office very, very gradual, although it's on its way up. But this is a sector where the global policies really drive return to office. Another aspect is that the IT companies here, they employ very, very large amount of people. They're all housed in one campus, and probably it's that again the density plays in here. That they would not want to risk too many employees being in one premise at the same time. So probably that's one of the reasons why IT is gradual in terms of its return to office. But yes, I think it's a pot boiler of all the points which Megan and Greg discussed.
Okay, thank you. Now we've got a couple of questions that have come in. I'm going to wrap them into one, and it is a continuation of that office theme. I think one aspect is about the repurposing of where as has been made clear in this discussion, this is going to be a bit selective markets, but repurposing of some secondary assets, and also about the use of flexible space, so for going forward. So perhaps, Megan, do you want to start on trying to provide a bit of a sort of overview on those two issues?
Yes, so I think some of this comes to, Greg very nicely laid out where he talked about what do investors want, what do occupiers want, what do governments want. And I think this actually holds the same about office usage. So what's the strength of the government, both at a national and perhaps a city planning level, in terms of who's allowed to do what with these assets? Some of it also comes to ownership structures. Do you have multiple owners of buildings, which we still have in Hong Kong? People use a short-term word for it as strata title. It's a version of it, and we definitely have that in India. Singapore has gone some way to saying you can no longer split up buildings by multiple owners in strata title. Now that will actually help in terms of the refurbishment of office. You've got a problem with what you do with old offices that are split up in this way, because you have to gather together owners in order to establish and get the sort of refurbishment process or the redevelopment process going. So you have, for some locations in Asia, got this initial barrier as to what do you do with these old offices? Are they all split up in multiple ownership with different owner-occupiers sitting in the space and different landlords? So that's actually a very specific Asia problem. Once you get outside Asia, that's much less of a problem. But then outside Asia, we've got older stock where we might have historic building standards that need to be accounted for. But generally, I think that if you're in the heart of a city, mixed use development, there are some terrific mixed use developments in Asian cities that actually from elsewhere in the world we could learn from what's going on in Asia. But I do think that the ownership piece is something to think about.
Okay, thank you. Yeah. So, and I mean, do you think, and in terms specifically of like flexible office space, do you see that as being something that it's going to, with this sort of slightly checkered sort of approach to office usage, is it something that becomes a bigger story going forward?
I'm going to pass that to Greg. It just varies by location. Greg, you have a crack at it.
Yeah, look, I think we look at it two ways. One is there's, and I'm not sure this is a word, but the hotelification of office space. So I think you look at office buildings in the future and tenants that are gravitating towards those buildings that are highly amenitized, highly connected, which Megan touched on earlier with regards to transportation, and I think also offer a degree of flexibility. And what I think our occupier teams have started to emerge is that companies are moving to buildings and prepared to pay higher rent on a square footage basis, but are taking less space. So, and the way that they're utilizing the space is different. So I think if you have a large enough development that offers an element of a fixed, more traditional lease and some flexible space and is highly amenitized, well connected, that to us feels like the office that's going to continue to perform, provided it's obviously in the right geographic location, which Megan touched on. But yeah, we really are starting, and again, hotelification, I'm not sure if it's the right way to describe it, but that's kind of where we're heading towards in terms of describing how offices has evolved over time.
Okay, great words. Thank you for that. Look, we are running out of time, so I'm going to just ask one more question of everyone, and it's going to be a reflection of the fact that I'm a sort of a very grim economist, and you guys are all optimists, in terms of the business. So, if I was looking for, I mean, look, there's clearly challenges facing real estate, but on balance, I've heard quite a lot of positive messaging coming through. And I suppose I'm thinking of what, if people listening in here, what is the big, risk that we all ought to watch out for in terms of the threat over the next few years, if things that could knock off course any sort of ongoing strength in the market or recovery where we're seeing it. And perhaps we should just start in India then, Suvishesh, and get your thoughts as, it's a pretty, you've talked a great story about the Indian market, but what are we might be concerned about? What could throw us off course?
I think the number one risk is, a prolonged recession in India. We are all of the belief that a mild recession is actually not going to impact, the Indian economy or the Indian real estate at all. But however, the duration of, this recession is something which we'll keep a close watch on, because naturally, the global activity is what, commercial activity is what drives, activities in India as well. So we can't be aloof to it for a really long time. That's one. Number two, I think, we'll again be keeping a close eye on the investment sentiment and inflation, because that's putting a lot of pressure on, margins. So, yes, the cost of inflation is high in India. That has led to, price rise in the residential segment, which could be easily passed on to the, consumers or the end users. That has also led to, rental rises. It is going to be, a big risk in terms of rise in rent in the industrial space, because land prices have gone up, construction costs have gone up. So inflation is going to be key. The good part is that we all see it tapering down in the coming quarters. However, how the geopolitical situation unfolds, what sort of demand supply mismatches arise because of supply chain logistics issues, these are something which we'll be keeping a close eye on, and these I believe is the biggest risk. Otherwise, clearly it's optimism.
Absolutely. And Megan, one from you on the macro.
Sure, thank you. So, biggest risk out there, we didn't know we were going to have a pandemic. We didn't know Ukraine was going to be invaded. We don't know what's coming next. So I think all we need to do is prepare, which is maintain cash flow. Always watch your cash flow. I mean that's on both a professional and a personal level. High inflation erodes the value of debt. So it's not to say that debt is bad in a high inflationary environment. In fact, debt might be quite a good thing. Go out and borrow some debt and watch it be eroded by high inflationary values. If inflation is running at 10%, the value of that debt halves in 7 years. So debt in and of itself is not a bad thing, but it's about the cash flow. So I think my key takeaway would be watch your cash flow.
Okay, thank you. And then so that's certainly a good lesson. Then Greg?
Two things for me. One is monetary policy overshooting, so that's related to inflation. So everyone's sort of talking that we're near the top of the cycle. If inflation accelerates or remains stubborn, could rates move higher from here? I don't know the answer to that. The forward curves tend to suggest not, but that is a risk. I think the other one is probably, and we sort of touched on, is geopolitics. Megan touched on wars, etc. That's a big macro risk. On the positive side, and I think Megan sort of touched on it earlier around the cycle, historically, buying in the next 6, 12, 18 months is the time that you'll make the most money in the cycle on a go-forward basis. So there is caution, or there's reason to be optimistic as prices correct. It does provide a magnificent entry point for people to allocate money, and over the cycle will achieve amazing returns. So the buying opportunity is coming, and people that are I suppose attuned to that and have capital to allocate will make money if they place that over that 6, 12, 18-month horizon.
Okay, well, we're finishing there on a still quite a positive note, despite my attempt to perhaps eke out a slightly more cautious message. But no, really good to hear your thoughts today. Thank you, each and every one of you. Thank you, Donglai, for your presentation, and thank you the panelists for their contributions. And really just want to thank everyone also for listening in and for the questions that we've received. At the end of the session, I think there's going to be an online poll which will appear on your screens just to try and get some feedback around the webinar. And also looking forward, there are a number of other events that you'll see that are being run in the WebF series. So please look out for future events running through the course of this year. In fact, they've just come up on the screen now, so you can see running through from next month where there are very specific ones to later in the year when there are the actual conferences, and they will be taking place both in Europe and and in New York this year. And you can also just keep in touch with everything that RICS and indeed RICE is doing through the WebF platform by the various sort of social media opportunities, be it Twitter, Instagram, and LinkedIn. So look, I'm just going to say goodbye to everyone. Thank you for dialing in. Thank you, panelists. And I look forward to being in touch with you all and having another session after the release of our next set of results. Thank you very much.
Thank you.
Thank you. Thanks, everyone.